All right, let's get right into it. Today, Friday, February 27th, 2026, the market sent a pretty big shockwave across the globe. We saw a sea of red on the screens, and we're here to break down exactly why it happened and what it might mean moving forward.
You know, the market is always trying to tell us something, but today it wasn't a whisper, it was practically a shout. So the big question we're tackling is, what was that message, and more importantly, what does it mean for the month ahead?
So let's look at the damage. Here are the closing numbers. You can see red pretty much everywhere across the major U.S. indices. The Dow took a real hit, down over 1%. But the one to really watch here is the semiconductor index. It's been the engine of this huge AI rally, and it got knocked down over 1.2%. Now, these numbers are the symptom. Let's get into the cause.
Today's sell-off wasn't just about one single thing going wrong. Nope, the source report we're looking at points to three distinct shockwaves that all hit the market at the same time, basically creating a perfect storm of bad news. Let's break them down one by one.
First up, the ghost that just refuses to be busted: inflation. I mean, just when the market was starting to get comfortable, thinking about interest rate cuts coming soon, we got a report that completely flipped the script.
And here it is. This is the number that sent an absolute chill down Wall Street's spine. The Core Producer Price Index, the PPI, came in at a scorching hot 0.8% for the month. Now, to give you some perspective, everyone was expecting something like 0.3%. So this wasn't just a miss, this was a massive blowout. It's a huge signal that this inflation fight is far from over.
So why does one number matter so much? Well, it all comes down to policy. The market instantly priced out any real hope of a rate cut from the Fed anytime soon. Fed officials started making more aggressive or hawkish comments, and the whole timeline for cheaper money just got pushed way back. The easy money party? It's on pause, for sure. Okay, so as if that inflation fire wasn't enough, another one started to flare up. This time, it was all about global trade policy, and man, the market got caught between two totally opposite signals.
And you have to appreciate the whiplash effect here. It's kind of wild. On one hand, you had the Supreme Court striking down these big, broad global tariffs. That should have been great news, right? A huge relief for global trade. But then, almost in the same breath, the White House comes out and proposes a new set of 10 to 15% universal tariffs. So that moment of good news was just gone, replaced by even more confusion. And that brings us to the third and final shockwave, which came out of the Middle East. It was the stark reminder that geopolitics can still throw a giant wrench into the global economy with absolutely no warning. Word started spreading that the nuclear talks between the U.S. and Iran were basically collapsing. Then, we got reports of an increased U.S. military presence in the area. And you know what that means. The market's reaction was immediate and totally predictable. Oil prices shot up. Both WTI and Brent crude oil hit 6-month highs, which just adds another layer of inflation pressure to a market that was already freaking out. So we have our three shocks: inflation, trade, and geopolitics. But the bigger question is, why was the market so fragile today? Why did it react so badly? Well, the report goes a level deeper, pulling in some really powerful economic theories to explain the underlying situation.
The first idea comes from Gunter Dueck, and it's all about emotion. He argues that this huge AI boom wasn't just built on solid fundamentals. It was supercharged by fear of missing out, FOMO. And when a market is driven by an emotion like that, it's incredibly fragile. That high inflation number was like a splash of ice-cold water that made everybody stop and ask, wait, is this for real?
Building on that idea, the report talks about something called malinvestment. It sounds complicated, but the idea is simple. For years, interest rates were near zero. Money was basically free. That encouraged companies to throw cash at all kinds of speculative projects, maybe some in the AI space, that just aren't sustainable now that rates are higher. So from this viewpoint, today's drop isn't some accident, it's a necessary correction.
And finally, there's a more technical view. This theory suggests that today's drop wasn't random at all. It was almost scheduled. Apparently, there's a key 40-month market cycle, along with a few others, that were all set to peak right around now. So in this view, the three shockwaves were really just the trigger for a downturn that the underlying market rhythms had already set the stage for.
Okay, so that's the diagnosis of what just happened today. It's the look in the rearview mirror. But what about what's ahead? Let's turn to the report's data-driven forecast and see what it's predicting for the month of March. And wow, the numbers here are telling a fascinating story. The forecast sees more pain ahead for U.S. tech. It's predicting the NASDAQ 100 will fall another 3%, and those crucial semiconductors could get hit even harder, down over 6%.
But look at the split here. The broader S&P 500 is actually expected to be slightly positive, and the UK's FTSE 100 is forecast to rise over 3.5%, probably because it has so many big energy stocks.
Now, let's turn our attention east, because this is where the forecast gets incredibly bullish. The report is predicting a major rally in Chinese and Hong Kong markets. Why? Well, it's all based on expectations of a massive stimulus package from the government. I mean, look at that HS Tech number, a predicted gain of 9%. South Korea's KOSDAQ is also looking really strong. This might be a sign that a major rotation of capital is starting.
And this chart just says it all, doesn't it? It perfectly illustrates this great divide the report is forecasting. On one side, you've got Hong Kong tech potentially surging 9%. On the other side, you've got U.S. semiconductors facing a potential drop of over 6%. It is literally a tale of two tectonic plates shifting under the global market.
So, with a forecast this complex, with so much volatility and divergence, how in the world do you navigate it? Well, the report lays out a very clear framework it calls the late cycle defensive strategy.
It really boils down to a three-part approach. First, play defense. That means managing your risk with clear stop-loss points on the big U.S. indices. Second, play offense. Go for alpha or outperformance by focusing on where the strength is, and that's those Chinese and Hong Kong stocks. And third, buy some insurance. Hedge your portfolio by putting some money into commodities like oil and gold, which can do well when things get tense geopolitically.
And here's what that strategy actually looks like inside a portfolio. The biggest piece of the pie, 35%, is set aside for that China and Hong Kong opportunity. But look at the next biggest chunk, 30% in cash. That is a huge defensive move. The rest is split between some select value stocks in the US and Korea and that commodity hedge we just talked about. It's a real blend of being cautious while also being ready to pounce on specific opportunities.
We have covered a lot of ground here. The shocks, the theories behind them, the forecast for what's next, and even a potential strategy. So let's boil it all down to the one core message from today's market action.
If you only remember one thing from all of this, let it be this. The game has changed. The conditions that fueled the last rally are different now. Easy money is on hold. The exciting AI story now has to be backed up by cold, hard numbers, and the data strongly suggests that the engine of global growth might just be shifting from the west to the east. And that leaves us with this final, really important question. In an environment like this one, where the old winners are stumbling and new opportunities are popping up, how do you position yourself? The report we looked at suggests a balanced approach, but it really makes you think. In the month ahead, is playing strong defense the smartest way to play offense? That's really the key question for every investor to think about right now.